So I'd like to talk a little bit today about sort of the global economy and post-financial crisis, just some ideas that I had. And questions that all of us have are ahead of us are really what is ahead for the global economy, and are we going to have a normal recovery from a severe recession? You know, that tends to be the standard model of governments and our central bankers, and that over a period of time we'll then have growth again, and obviously we need jobs, we need wages for consumption to grow in our economy. You can't have consumption growth without having jobs, and you'll have growth and then recovery and investment. So that's the first sort of way to think about things. And the second way is, are we still going to be mired for many, many years in a debt deflation fiscal crisis with monetary policy trying to cause the lack of decay of the economy and try to inflate it or reflate it, so that we have all these fiscal and monetary imbalances in the Western world, and that need to be corrected and are going to take years to unwind. And the third component is really of this: is there an underlying structural change in our economy that is going to have a lasting effect on jobs and education, and the need to retrain large components of our society? And this really relates dramatically to what will happen in Africa and China and the other BRIC countries that were mentioned by George earlier. So I think that the geography is becoming smaller in the world, and the way we produce goods and services are going to change dramatically. And so what are the international consequences of the evolving crisis, and what does that mean also for the investment outlook? So I think the first school of thought is that from the central bankers of the world, although there's a severe recession, we're slow recovery, we're mending slowly, and we're on our way. You know, and we can think of that as fragile but slow recovery, and we're having a mean reversion. That's the central bank model, or the government model. We have recession, we have then recovery. However fast it comes, it's mean reverting to a trend or an upward growth of our society, as opposed to a complete shock, which changes the trajectory from that point forward. So it's a liquidity crisis, and basically every central banker wants to do research or have research done in the central banks which indicate that it's a liquidity crisis, which means that there's a lack of liquidity in the system that causes asset prices to fall, liquidations to occur, and if these liquidations occur, it takes time to restructure banks and restructure the economy. But it's liquidity, it's not solvency. And the reason the central bankers, Mr. Bernanke at the Fed and Draghi and ECB, etc., are interested in it being a liquidity crisis, because if it is a solvency issue, why didn't they find it on their watch? The banks really got in trouble. So if it's solvency, they should have found it before. So they always want to deny it's a solvency problem and it's just a liquidity problem, because they don't want to take responsibility for it either. So I think the school of thought really says that we will have central banks trying to reflate the economy by having various programs which are called quantitative easing. And because every banker is afraid that if there's deflation, and the deflation is too large, that means prices are falling, then basically that means that the real rate has to go higher and higher. And deflation, with a deflationary economy, it means that we defer consumption because prices are falling, and also real estate prices tend to drop and investment tends to fall. So I think macro policies are deemed to stop deflation and tend to be working. There's been about a $2.5 trillion increase in the U.S. in the balance sheet of the Federal Reserve Bank, up from something like about $500 billion before the crisis. So they've added a lot of liquidity to the system, by not only by buying bonds in the market, and especially buying up a lot of our mortgage bonds because the real estate market had fared so poorly in 2008. It's interesting that we've had on average growth in the United States since the crisis of about 2.4%, while the real GDP has only grown about 0.6% a year. So we haven't had growth yet, even though that we've had a lot of stimulus, a lot of pumping of the economy through very loose monetary policy and overt action to add to balance sheets. In fact, if we look at the balance sheets of the central banks around the world, they've increased currently to around 16 trillion US dollars. Okay? So that's a massive amount of assets they've accumulated and financed it essentially, and doing a lot of financing of the deficits of our governments generally. So it's not limited only to the United States. It's also involving other central banks around the world, including China, that has added a lot of stimulus to finance infrastructure projects in the various provinces. So they want to have. It's a very interesting experiment that's going on now around in Japan. Japan gives us a very interesting experiment, and we will see whether other central bankers around the world follow this experiment. And they've had deflation since the 90s with very low interest rates. The government debt to GDP ratio is now over 200%. And they've had a very timid monetary policy, no growth, and high real rates in the economy. The new Prime Minister, Mr. Abe, wants to aggressively lower the value of the yen. So actually depreciate it from the 80 level to currently 93 level or so, and maybe going as high as 100 to the dollar. As a result of that, they want to stimulate exports, try to stimulate exports, at the same time grow the economy by 2 to 3%, and encourage the $17 trillion US dollar equivalent of savings or cash that persons hold in Japan, and make that active in investments in Japan, as well as encouraging foreign direct investment of their corporations abroad. Increasing wage levels in Japan. And there is a very interesting book, there's a very interesting Prime Minister of Japan. He was assassinated at that time. They're not exactly sure who, but it was thought that it might be those related to the armed forces who did it. And then Japan obviously ended up in a very large inflationary pressure after that time, and we know the consequences of that. So I think that we're going to see if the Japan experiment, which is really combining monetary policy, very loose monetary policy, and at the same time fiscal stimulus to try to jumpstart the economy works. Obviously, that means we're going to see in the global economy potential other countries trying to respond. Because if the Japanese exchange rate becomes more favorable for Japanese exports, it means that they're going to be competitive with regard to German cars, for example, heavy industry, and lots of other activities, and the profits of Japanese companies will increase demand for more labor, etc. But that could set off a wave around the world in which other countries tend to want to reduce the value of their currency vis-a-vis the yen, and institute exactly the same policies that had been instituted previously by Japan itself. Now, the elasticity, if you look at the numbers, Japan is very sensitive. Its growth rate in its GDP is very sensitive to actually the yen because of its export base. The United States is not as sensitive, and other countries that are export-based, such as Korea, are very sensitive. So the question is whether these policies themselves will be followed by other countries, but it really means that that's something we're going to have to watch in the next number of months, to see if we end up with currency wars. And even though every time we have a meeting of the G20, everyone says we're not going to have currency wars. It's not having a currency war, it's the policies that you use to try to deflate the value of your currency vis-a-vis others that causes export change. And I guess that Kenya and others countries who are worried about exports and imports into their own countries realize that their policies are not independent of the policies of other countries. So it's a monetary, so this is a gigantic experiment. And the interesting part is that the central banks of the world responded to the 2008 crisis, and that was correct. They put liquidity into the system to allow the economy time to heal. Now we've moved in 2010, 2011, to unconventional monetary policy. We've never seen monetary policy like this before, where the central banks build up their balance sheets and core reserves in the system, trying to cause interest rates, change interest rates, cause individuals to try to move into risky assets. So if that's your policy, to have a wealth effect where you have increases in people's wealth in the stock market, increases in people's desire to move to higher yielding assets and take greater risk in the economy, and that policy is completely new. So there's no way that we know what's going to happen, how they're going to get out of this, because we've not had an experience such as this in the world before. And as a result, it could work out that we're going to have quantitative easing or asset purchases of the Fed forever. Either they're just going to run off naturally themselves, but it's going to be very hard for the Fed to exit these policies, and very hard for the Federal Reserve Bank in the United States to raise interest rates in the light of inflation, because if they raise interest rates and this economy is still soft, because they need to control inflation, that means essentially that the deficits of the government will increase dramatically because of the cost of financing their activities and the interest rate that's paid on debt. So I think that the second factor that we have to look at is people say the economy is recovering, the stock markets are higher in the US, wealth effect is large, but if you look at even the housing recovery seems to be coming along, even though not robust. We seem to be having recovery, and so the economy tends to be mending there. But I think that basically we are, through the Fed policies, borrowing a lot of future return from the valuations we've had in the market today. So the growth rates in the market that we've had in the past, in my view, will not be there in the future to the same extent they have been. So that means potentially that if there are other regions of the world which offer higher rates of return than U.S. markets, then investments will flow from the U.S. to these other regions, such as Africa or other emerging markets. And so we will see, whether the market can sustain itself, and even in ECB, when we've had the European Central Bank, even when we had a very unsustainable situation in Europe, which I'll get back to in a moment, but even there, the idea of trying to think about reducing debt overhang through inflation or growth or debt restructurings, possibilities of lower exchange rates are all uncertainties that we have going forward. But basically, the overall school of thought, which we were mending slowly, the economies of the West are mending slowly. China has some problems, but with the new government, it's going to be able to continue to grow, even though there's a lot of imbalances within China. There's another market country that's very close to Africa. And Europe itself is a mess, but what they want is stability. That's what they tend to do. So they'll try to keep Europe stable any way they can, even though the recent decision with regard to Cyprus does signal that instead of bailing out governments and governments bailing out the banks, so that the depositors of banks and the other liability holders end up getting away scot-free. It seems now that Germany is not willing to do that, underwrite entirely. So depositors within Cyprus are now going to pay partially for lose money on the default of the banks. And similarly, that now could signal other countries within the Eurozone, other depositors within the Eurozone, that they too may be susceptible to losing some of their deposits. As a result of that, we could end up with capital flight or slow capital flight moving away from deposits in their own country. So I think that the themes of the last decade that I have observed, and it's always easy to know what the themes of the last decade are after the decade ended. So I'll be an expert on that. But one is that we had the World Trade Organization for China in when they signed the accord in 1997, led China on a tremendous growth path. We're now if you use total GDP as a measure, and I don't really like using GDP because gross domestic product is only the flows from activities, not the value of what you've added to the economy. And so I think that China's infrastructure and state-owned enterprises and their small and medium enterprises are growing dramatically. But it was infrastructure investment based, and China will try in the years ahead to move more people from the agricultural sector to new cities in China, which means more infrastructure, but the plans ahead are to move to a more consumption-focused economy and away from infrastructure-driven investments. In the U.S., we had, unfortunately, in 2001, the World Trade Center bombing, and which led to wars in the United States and a lot of fiscal and monetary stimulus over the 2000 period that really led to excesses with lax regulation. And I thought it really stimulated a lot of false growth in the United States and asset bubbles that occurred. So I think that if you look at the percentage of gross domestic product that went to labor, it has fallen dramatically since the 2000 period to today. In the United States, the percentage of our gross domestic product that has gone to capital has gone up dramatically. So what has happened from 2000 on is that consumers who are not having wage increases to keep up essentially use the very loose markets to borrow against their homes and use the low interest rates to borrow money, and as a result we're able to continue to consume. So that's obviously not going to be going forward. And I think in addition, because of the birth of the euro in 1998, we had a consumption asset inflation boom in the periphery, the Spains, the Irelands, the Portugals, Greece, etc. All of these themes are going to slow and reverse in the next decade. So I think that for the United States, and I think the United States will grow. I do believe that's a hypothesis that I have. And I think we are going to see a tremendous change in what we're going to do. My themes that I see for the next 10 years or so is insourcing. The idea that is the technology that we are developing in the United States is making us more competitive, and we're moving more and more production back to the United States because what we can do with technology or insourcing through technology is making our production runs very flexible, very idiosyncratic, and make things much faster in terms of R&D development and new product innovation. With the cost of energy still high, even though my second theme is that the U.S. is becoming more energy independent and is using less foreign oil, and it's not growing in its use of oil, but the price of oil is set in the international markets. And even though our consumption hasn't increased, the price of oil has increased quite dramatically since the 2000. And when it's gone from $25 a barrel to close to to $100 a barrel. So energy sources, oil and the like, are really an important theme of this decade, in addition to what we are going to do to change the structure of our resource consumption. And so that will lead to a lot of new technologies that will interface with that. And I think another issue that we're going to see, and it's already starting, is what is China going to do? I think that they're going to try to internationalize the yuan, the RMB, and really make it as a competitive currency, which means opening up credits and trade within the RMB itself, as opposed to using the dollar as a way to translate. So that means we'll have whole new market structures where the dollar will be used in certain structures, and the RMB will tend to be used with other trades in that, and that's essentially also, we see that in addition in how that China's trying to interface with other BRIC countries within Asia, and the treaties that they're going to have within Asia and also within Africa itself. So China is going to become, because it's so resource scarce problems in China, that basically the relation between China and other emerging countries will continue to evolve, and we'll see more convertibility of the RMB. When you see convertibility of the RMB, then we see a market in which China becomes very competitive, and they too will insource. They won't rely as much on exports, but they have to move up the value chain and are investing very heavily in technology, very heavily in new investments to add value. So for their own production facilities. And so there's a very competitive now between technology development in China and technology development in the US and obviously in Europe and other parts of the world as well. So I'm going to skip this because of time, but I talked about the second school of thought that we have is going to be our debt deflation restructuring world, which will take a long time to unfold or to be able to eliminate. And as I said, I think that when we think about growth, we want to think about how we increase the value of our education, our human capital, which is one of our scarcest resources, and at the same time undertake investment projects that add value. One of the problems that China has right now is basically that a lot of the stimulus money that went to the provincial governments was used for infrastructure projects that didn't really have value enhancing. They weren't value enhancing, so the money that was spent actually returned less than the money that will return less than the money that's spent. So when you decentralize, as we're doing in Kenya now, and money is being channeled to those who know what to do in the local areas, one must be careful that the projects that are being undertaken are actually adding value and covering the costs of capital in undertaking those projects. So I think that the debt in the public sector has increased dramatically, and the debt overhang is quite large. And there's still the implications that we have of outsourcing standard form production from the US and Europe to the emerging markets. As the emerging markets, such as China, are needing large infrastructure developments, then you have cement and steel and autos, and that can be produced en masse in very economical ways. So there's a difference between idiosyncratic production or idiosyncratic needs and mass production, which is involved in outsourcing. And then we also have automation or insourcing, as I've said. And I think that the things that I think are going to change the themes of the next 10 years in terms of automation are the effects of big data and how we analyze big data to provide more efficient services to people, making things more idiosyncratic to their needs. Cloud computing, which is making startups, the cost of startups so much less, so new innovations can be done more quickly, they can be done with less cost. And how we're going to use artificial intelligence to do things. I mean, artificial intelligence and the way we provide medical services, the way we provide we're replacing jobs. They're being replaced dramatically. And no job is really any more secure when you have artificial intelligence. I think if we had this IBM had this computer called Watson that actually has artificial intelligence built into it, and Watson actually has a huge database of information and can come up with answers to myriad questions, and those answers are accurate, much more accurate, and will continue to become more accurate than human beings. So we will see in the future where a Watson, a computer robot, is downloaded with all the information on every medical book downloaded, every medical paper downloaded, all the diagnostics downloaded about that particular patient or other patients that have similar things, and that Watson will give its view as to what's wrong with the patient, and probably do it more accurately than an experienced doctor could do, such because the doctor doesn't have as much information, or at least that you're going to see a completely new way in which medicine is going to be provided, and making the old way of redeveloping and pricing and selling electricity obsolete. I'm always very impressed with the self-driving car that Google is building, which drives around Palo Alto now, where we at Stanford University, the person sits in the seat next to the car, but it drives itself. So think about a world in which we have fleets of trucks, and so instead of every car stopping here on your roads, so you can't get anywhere, that each car is linked together as it's driving by itself, so that there's no whip effect where it takes the first car a couple of seconds to get going, the next car a couple of seconds to going. So by the time the light changes, the last car has already lights changed back again and has to wait. So all those loss of energy and power and pollution that's created by the simple fact that we have these inefficiencies in the way we drive as human beings. And additionally, think of fleets of trucks going through the United States, all run on self-driving convoys in which logistics sends trucks in one direction and sends them off on their own. All that's coming. But that means we could lose 3.5 million paid truck drivers and 0.57 million bus drivers and 0.3 million taxi drivers in the United States alone. So there's job elimination is really the interesting question, which means we have to prepare a class of new citizens that are educated in a completely different way than the way we've educated them in the past. Distance learning, we've talked a lot about that in this training, also for Kenya and other parts of the world, even in the United States itself. What is distance learning and how we're going to evolve distance learning, and that's going to be a very important way in which we can increase the human capital and the value of human capital for citizens locally and globally. Robotics is everywhere. I mean, I was in December, I was at a kibbutz in Israel, and a kibbutz, which is a cooperative where people live on the farm. And there's the idea that you have all these people there. So they have a business that they're running, which is at the one kibbutz, which is making pipe fittings for plastic pipes. And so I went into the factory thinking there's going to be hundreds of people there. No, there was only robots. Robots were doing everything. And the only thing that a person was doing was taking the push cart, which is as the pipes came off, the fittings came off the conveyor belts, and then moving into a storage area. So the idea of robotics is important, and I think, for me, one of the most exciting changes that we're going to have in manufacturing over the next number of years is 3D printing. That whole changing of manufacturing from mold-based structures, which is what are you going to produce, to more idiosyncratic production. Once you have a specification in a computer, and you have the dimensions in that computer, once you have those specifications, we're learning how to print that right now. And that if you can print something, you don't need a mold, you can do it by extrusion, so you can have it layering, and that is We're going to hear so much more about 3D printing and what we can do with it in the years ahead. I think in the United States now, about 20% of production is actually being done by 3D printing. And the idea is that once you have, what does that mean? It's the flexibility to make things more idiosyncratic, to change things. Instead of having a prototype being done and then sent, say, to China to produce the first mold of it and send it back to the United States for the person who wants to buy it to look at it, and then make changes, and the cost of making those changes in terms of lost time will all be eliminated, because basically if you can print it right in front of you, just in the same way as you can print your term papers and see them and change them, that gives you flexibility, and that's a huge value. But optionality or flexibility has a cost, and if we can reduce the cost of that option by reducing that cost, and everyone wants to do that. So we have a real problem in terms of the jobs that we could lose in our society. And we've already lost 7.5 million jobs in the US and 7.6 million in the Eurozone. And it's from paid middle class wages, 2/3 because of technological changes. And so we have to move people up the pay scale. We have to keep moving people into jobs. And the real interesting question, when I was younger, I always felt that it was the case that if we gave a person a machine, the machine made the person more productive. The person benefited in the sense they would gain from the productivity by having higher wages, which allowed them to consume more, allowed them then to spend money on their children for education, on their homes, on other consumption goods that they had, and provide for a better life. So machine to person adds value. So, but that's a complementary theory, and that's been the standard theory of economics. But then if you have a substitution theory, which says the machine replaces the person, okay, then the person has to find new jobs and new things to do. And to do that, you need a more flexible educational system. Because if machines are always coming, okay, to replace, then the person who's lost their job has to have a way to move into another area to become more productive. Okay, so the question we have is, what is going to be ahead for the global economy, and what are politics going to do? I talked about here technology, I talked about resources, I talked about human capital, and now talking about politics. And the really interesting politics is what does that do to the economies? And we're going to have trouble going forward, I believe, because of politics and political direction, at least in the United States and in Europe, and with the various programs that are being put into place. Obviously, government noise and rules and new regulations and ways of doing things creates uncertainty. And the more uncertainty you have, the more it's necessary to set up protection or have risk capital to be able to withstand or the uncertainty that's going to occur. And we have a lot of uncertainty that is actually either imposing new regulations on the financial sector, new ways of transferring money. And I think that, okay, thank you. So government regulation is one of the things we're seeing, which is trying to create reforms. Government finances are really not there in the United States for a large stimulus. Even those of you who read the New York Times and see what Krugman is saying or Stiglitz is saying, they're particularly hedged. They say, well, we need more stimulus, and if the economy doesn't recover, there's not enough stimulus. So if they got too much, there's never enough stimulus that it's going to work. So there's nothing they can say that in the short run, we know that Keynesianism does work in the sense that in the short run, if the economy is in recession, and having the government step in and provide services and is a way in which the economy can recover. But the problem is it can't keep doing that because the economy has to recover on its own. So, and that is really the important point to realize that Keynesianism is really only a short-term model and not a long-run solution to problems. And I think that we know in the European situation, it's going to be very fascinating to see how they get out of the current problem and whether having a euro, which is a common currency when you don't have the free movement of labor and capital, and you have a great resistance to people reducing their entitlements, and austerity has never worked. The only thing that has ever worked over the history of, if you look at history, it's always telling you that inflation works, or the idea of reducing the value of your currency works. And what it does in either case, it reduces wealth by reducing the value of your currency, allows for exports to occur, and at the same time reduce the value of your currency. That means you inflate because your goods and services you buy cause them to be more expensive. And so the policy of inflation works, but if you have your hands are tied, you have one central bank, and certain countries within the Eurozone, such as Germany, do not want to inflate. They want their currency to be strong because they want to protect their wealth and not reduce the wealth, and they, at the same time, do not want to inflate by having wage rates in Germany going up and property prices going up dramatically. That means that the periphery has to bear the brunt of having reduction in their wages, having reduction in property values, and having government expenditures being curtailed just at a time when the adjustment process is going on. So as a result of that, we have great political difficulties in the periphery, and whether the population is going to stand for it is a real issue. So I think it's because votes work. If the Italian government, the technocratic government, wanted to instill austerity problems, what they never did was how we're going to have growth. So you can't sell a program of austerity to your citizens unless they understand how things are going to grow. Where's the growth coming from? And that's what was never done. And the way you have growth is you get rid of what's called the structural impediment, which is really a nice sophisticating sentence, but a statement, but it really means what regulations are impeding the private sector from enabling itself to grow and to invest and to make money. And that's, unless we end up addressing those questions, there's not going to be the growth that we need. So I think I'll end there.